Welcome back, traders. If you've ever been frustrated by your stop losses being triggered right before the market moves in your favor, this video is for you. Today, we're diving into the concept of liquidity in the market, especially when it comes to stop losses. A lot of retail traders lose money because they don't understand the dynamics of liquidity. But after watching this video, you'll have a much clearer understanding of why these things happen and how to position yourself better in the market. Whether you trade forex, stocks, or indices, this principle applies universally. So stick around because what you're about to learn could change the way you trade. Let's start by defining liquidity in a more relatable way. Liquidity refers to how easily assets can be bought or sold without drastically changing their price. But for us traders, the more important concept is how liquidity behaves around price levels. Think of the price action as the battlefield. The market is a predator and it's always hunting for liquidity. Stop losses are just the prey. If you've ever placed your stop loss right below a low or above a high only for the market to spike and hit your stop before reversing, you've experienced the liquidity rate. In simple terms, your stop loss is liquidity. The market comes back to raid these levels, filling the orders there, and then continues in its intended direction. It's frustrating, but once you know how to spot these liquidity zones, you can stop being the prey and start being the predator.
Now, there are two main types of liquidity in the market: buy stops and sell stops. Buy stops occur above current price levels. These are areas where buy orders are triggered. For example, when traders place stop losses above swing highs, thinking they are protecting themselves, those stops actually create liquidity. Institutions will target these zones to trigger orders, causing a spike before reversing the price back down. Sell stops work the same way, but in reverse. They occur below price levels, often forming at swing lows or equal lows. When price drops to raid these stops, it creates a liquidity pool. Once these orders are triggered, the market usually reverses upward. What's key here is that liquidity tends to cluster around obvious levels: swing highs, swing lows, equal lows, and consolidation areas. Smart traders recognize this and avoid placing their stops in these obvious areas. Now, let's talk about why the market hunts these stops. You'll often hear traders complain that the market is out to get them, but it's not personal, it's just how liquidity works. There are two types of stops the market hunts. Retail stops, these are the easy targets. Retail traders tend to place stops at predictable levels like just below support or just above resistance. When many traders do this, it creates a pool of liquidity, which the market can exploit. When price hits these stops, it generates order flow, which helps move the market. Institutional stops, institutions place their stops farther from price action, often beyond major swing points or consolidation areas. But institutions are also aware of where retail traders place their stops. They'll use the liquidity from retail stops to fill their own larger orders, leading to what we call stop hunts. By clustering stops around obvious areas, retail traders inadvertently create the liquidity that institutions need to execute large trades. This is why price will often spike up or down, clear out stops, and then move in the expected direction. Understanding this dynamic is critical if you want to avoid being part of the liquidity pool. So, where do these liquidity pools form and how can we identify them? Support and resistance levels. This is where many traders make the mistake of placing their stops. They believe price will bounce off support or get rejected by resistance. However, the market loves to punish breakout traders by creating fake outs at these levels. It clears the liquidity and then the real move happens. Highs and lows of the market. At swing highs, you'll often find clusters of buy stops, while sell stops rest at swing lows. The market often targets these levels to trigger liquidity. After that, you'll see the market reverse back into the opposite direction. Consolidation zones. Whenever price is stuck in a tight range, liquidity is building up. The market will eventually make a sharp move, either up or down, to grab liquidity from both sides before making the true directional move. This is why consolidation zones are dangerous for traders who are unaware of this. Here's a classic example of how liquidity plays out around support and resistance. Imagine retail traders see price bouncing off a support level. They enter long positions, placing their stops just below support. As the price rises toward resistance, they aim for their target. But what usually happens? Price reverses, breaks through the support, takes out the stops, and only then does it move in the intended direction. That's the market using your stop losses as liquidity. It's a common trap that many traders fall into, especially breakout traders who aren't aware of how liquidity pools form. By recognizing these traps, you can avoid placing stops at predictable levels and stop being part of the crowd that gets caught in these moves. Let's apply this concept of buy stops and sell stops to a real-world example. Imagine price is nearing a resistance level. Retail traders are going short, placing their stops right above the swing high. What happens next? The market spikes upward, triggering all those stops. That's liquidity being taken out. But here's the important part: after the liquidity raid, the price often moves in the opposite direction. This is because the market has collected enough orders to move more freely. Institutions need this liquidity to fill their larger positions, and once that's done, price can reverse and head toward the intended target. This concept is mainly used by algo traders, institutions, and hedge funds. They need the liquidity created by smaller retail orders to make their trades possible. Once you understand this, you can start positioning your trades like the pros. To sum it all up, liquidity is a crucial concept that every trader needs to understand. Retail traders unintentionally create liquidity pools with their stop losses, and institutions use these pools to fill their orders. So next time you're setting your stop loss, think twice before placing it at an obvious level like just below support or above a resistance. Instead, look for areas where liquidity is likely to be hunted and avoid those traps. Thank you so much for watching. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more trading insights. This is PreedFX, and I'll see you in the next one.